Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. After the Federal Reserve announced a 50 basis point rate cut on September 18, global capital markets reacted significantly. This decision not only impacted global stock and bond markets but also sent shockwaves through the commodities markets. Today, Reuters published an article titled "How the Fed's Rate Cut Impacts Copper and Aluminum," which offers insightful analysis. Sharing this article aims to help readers understand how the Fed's rate cut transmits through various capital markets. Using this approach, one can also analyze how the rate cut might affect the Chinese yuan. Here's how the article breaks it down. With the Fed cutting rates by 50 basis points, investors are increasingly focused on how this will impact global commodities, particularly copper and aluminum. HSBC analysts outlined two potential scenarios to provide their outlook on how copper and aluminum prices could perform under different economic outcomes. In the soft landing scenario, the US economy avoids a recession, and the Fed continues cutting rates. Under this plan, HSBC predicts an additional 100 basis points cut this year, followed by another 75 basis points next year. If the Fed proceeds as expected, copper and aluminum prices could follow a pattern similar to 2019. This scenario is considered quite likely. If the US economy stays out of recession and the Fed continues its rate cuts, we may see a repeat of 2019's market behavior. HSBC's report described the 2019 rate cut as part of a broader effort to avoid economic slowdown. Copper and aluminum prices remained in a narrow range because the market had already priced in the economic slowdown. If this scenario plays out again, we could see a repeat of 2019's trends, where demand had already weakened before the first rate cut. It took about 2 months for copper and aluminum to form a W-shaped bottom, after which prices gradually recovered. The muted market reaction was due to the rate cut being seen as a tool to maintain economic stability rather than address a crisis. This limited both the upside and downside potential of these metals. Similarly, in the upcoming rate cycle, we could see a modest recovery, but unless demand rises sharply, prices are likely to remain range-bound. This part of the report is crucial. It suggests that under the Fed's continued rate-cutting plan, the impact on copper and aluminum in the commodity futures market would lead to price fluctuations. However, these fluctuations are not expected to be dramatic because demand had already weakened before the rate cuts, and the cuts are primarily meant to stave off a crisis, not drive market growth. As a result, prices will likely stay within a limited range. The other scenario considers what might happen if the US economy falls into recession after the Fed cuts rates. According to HSBC's report, if this happens, copper and aluminum prices could follow the pattern of the early 2000s dot-com bubble era. In a recession, historical trends suggest copper could drop by 34% and aluminum by 28%, with an additional 20% decline expected next year. The downturn would likely continue until the US economy starts growing again. In contrast, under the soft landing scenario, where the US avoids a recession, prices might fluctuate in a W-shaped pattern. HSBC projects a 12 to 15% decline in prices, followed by a rebound to current levels, with prices oscillating between these points. Here's my take on this report. Whether in the commodities or securities markets, there's a growing consensus that the Fed's rate cuts won't bring about a major market shift. The core reason lies in the fact that the current US benchmark interest rates are still at historically high levels. Even with the rate cuts, they remain at levels that are unsustainable for US and global businesses. Unless these high rates are brought down to normal levels, it's unlikely we'll see any dramatic changes in the market. The second key news story is a major headline across international media today. According to a Reuters report, Ukraine says it hit 2 Russian munitions depots overnight. The destruction was caused by drones, which, after being shot down, started fires that spread to ammunition supplies. For the second time this week, large Russian weapon storage facilities have been targeted. Ukraine's general staff shared on Telegram that at least 2 major Russian military warehouses were hit overnight. One of the depots was located near Zahoryetsk in the Krasnodar region of southern Russia. Local officials stated that debris from a downed drone sparked a fire, prompting the evacuation of 1,200 residents. Ukraine also claimed responsibility for another strike on a military depot in Shyokino, a town near the Tver region, located north of Moscow. This facility is connected to the Russian Ministry of Defense's Chief Artillery Directorate. Earlier on Wednesday, Ukraine used long-range drones to destroy another significant Russian weapons depot, causing tremors in the surrounding area due to the size of the explosion. Today's strikes follow closely on the heels of that attack, which targeted a massive arsenal. Both explosions have been confirmed by Russian media outlets, further verifying the scale of the damage. In reflecting on these developments, I've noticed a growing trend. Ukraine's drone capabilities seem to have improved significantly in both number and range. Clues from various media reports suggest that Ukraine's drone manufacturing has made substantial progress recently. This ties into the broader European Union support package of €39 billion that we discussed yesterday. Part of this funding is set to purchase weapons produced in Ukraine, as proposed by President Zelensky. This creates a virtuous cycle, where the influx of orders for Ukrainian-made weapons leads to more resources for expanding and improving production capabilities. This is a positive sign for Ukraine's defense efforts, as sustainable funding and production are key to maintaining a long-term military campaign. The third major news story comes from an Associated Press report. Biden tells Quad leaders that Beijing is testing region at turbulent moment for Chinese economy. The report states that on Friday, President Joe Biden welcomed the Australian Prime Minister at his home in Delaware, kicking off the weekend Quad Security Dialogue Summit. Biden has been a strong advocate for strengthening the Quad alliance to counter China, and choosing his hometown of Wilmington, Delaware as the venue underscores the personal significance of this summit. The leaders of Australia, India, and Japan are all attending, making this Biden's final Quad summit during his term. Last night, Biden held a one-on-one meeting with Australian Prime Minister Anthony Albanese at his home, and over the weekend, he is set to meet Indian Prime Minister Narendra Modi and Japanese Prime Minister Fumio Kishida. This could also be Kishida's last trip to the US for such a summit, as Japan's Liberal Democratic Party will hold elections on the 27th, which may result in a change in leadership and a new Prime Minister. Here's my take on this news. The regional alliance that the US has built in Asia to counter China has been notably effective. In addition to the Quad alliance between the US, Australia, India, and Japan, there's also AUKUS, a quasi-military pact. Today, Australian Prime Minister Albanese told the media that he believes AUKUS will continue to be supported by any future US president, no matter who wins the next election. This comment suggests that Australian leaders have likely had discussions with representatives from former President Trump's camp as well. Furthermore, the US has also formed a regional military alliance with Japan and the Philippines, demonstrating a multi-layered and multifaceted approach to countering China's influence. This strategy is clearly being pursued in a methodical and bipartisan way, ensuring continued progress regardless of political changes in the US. At last, there's a significant story that's grabbing attention, especially among our viewers. There's a growing consensus that Chancellor Olaf Scholz is likely to step down next year. We're excited to dive deeper into some of the international news that matters. Today, The Economist published an article titled, Friedrich Merz, Germany's Chancellor in Waiting. So, who is this potential future leader? What's his political stance? These are key questions worth exploring. Friedrich Merz, at 68 years old, is the leader of Germany's centre-right Christian Democratic Union, CDU, the party formerly led by Angela Merkel. He has a unique presence in German politics. Merz gained prominence early on as a leader of the CDU, but faced significant challenges due to the rise of Merkel. After Merkel took power, he found himself sidelined, eventually leaving politics for the private sector. Though he participated in some think tank activities, his influence waned during Merkel's tenure. In 2018, Merz publicly urged Merkel to resign, but the CDU chose to keep her in power, allowing her to serve until 2020. Throughout Merkel's time, he was consistently overlooked for candidacy positions. However, following the CDU's significant loss in the 2021 elections, Merz seized the opportunity to reclaim leadership and gained broad support within the party. What distinguishes Merz's political stance from Merkel's and Scholz's? The Economist notes that Merz has been careful in his approach, working to reassure the moderate wing of the CDU while signaling to voters that he's steering the party back toward conservative principles. This balancing act has not been without its challenges. Last year, he faced backlash for suggesting that too many refugees were taking appointments from German doctors, which some felt echoed far-right sentiments. Despite some controversies, Merz's efforts have paid off. In May, he won re-election as the CDU leader with ease. The party appears to be more united now, with potential rivals rallying around him, significantly increasing his chances of ousting Scholz in the upcoming election. Why is there such a strong belief that Scholz will be out? Beyond the struggles of his center-left Social Democrats, his coalition partner, the Greens, is also facing a downturn in support, making the governing alliance unstable. This situation has led to widespread speculation that Scholz's departure is a done deal, while Merz is poised for a comeback. On immigration, Merz has adopted a more hardline stance, clearly shifting right. In foreign policy, he aligns with conservative, pro-NATO positions. For instance, he criticized Scholz for not sending Taurus cruise missiles to Ukraine, arguing that Scholz's approach is too timid. It's worth noting that Merz's perspective on the EU is somewhat cautious. He seems more inclined to collaborate with the US rather than committing substantial resources to the EU. While this sentiment is often implied rather than stated outright in German politics, The Economist has made it clear. As such, Friedrich Merz's movements and policies are definitely ones to watch. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.